Sunday, January 21st, 2024, Maneko 64, home of alternative economics and contrarian views. Today we're going to look at how rising bond yields are going to devastate the value of baby boomers' nest eggs. So we first need to understand what a bond is. Well, a bond is nothing but a securitized loan to a government, to a homeowner in the form of a mortgage, or to a corporation in the form of a corporate bond. And it can be from 3 months to 6 months to 30 years and so on. So what we need to look at first is how the relationship between the price of a bond and the yield works. So for example, if a government borrows £100 at 5%, issues that bond, and what do I mean by issuing? Well, it goes into the market, it performs an auction, and investors buy that bond at £100, and they get a 5% fixed coupon, let's say for 10 years. The day after they issue the bond, that bond starts trading in what's called the secondary market. And let's say that in 6 months' time, the price of that bond drops, let's say to 95. And why would it drop? Well, because investors see that that government is continuing to spend massively. It's running big deficits. They see that CPI or inflation is going up. So they want more than 5%, so they sell that bond. The coupon's still 5%, but let's say the price is 95. The yield on that bond is going to be more than 5% because you take the 5% coupon, you divide it up by the price, and you get a higher yield. The value of the bond, of course, that you might have bought goes down, of course, by 5%. So your investment in that bond goes down as well. And the other thing it does, the value of stocks go down as well, because let's say ABC Corporation might be paying a dividend of 4% when that government issues that bond. So the same thing's going to happen for stocks. They're going to have to match the government bond yield, and to do that it will go down in price. The other thing as well about bonds is that the more you can borrow, the more money there will be in the system, and the more that money will flow into investment assets. So yeah, the lower the yields go or interest rates go, the more money is sloshing around in the system, the more the government can borrow, the more you and corporations can borrow, and the more assets, the more the value of the assets go up. And now we're going to look at what happened since the early 1980s. We've had a bull market in bonds up until 2 years ago. And what does that mean, a bull market? Well, it means that, as you can see here from these charts, and I've got the 5-year gilt yield. The gilt is the equivalent for US treasuries in the UK. And I'm doing this about the UK because that's where I am. But you can apply this baby boomer devastation to anywhere around Western Europe, the United States included. So you can see that we had a bull market in the price of bonds because yields were dropping and for 40 years. Yes, there were periods where they rose, but that was just a counter trend rally in the yields or a correction in bond prices. And yeah, it's just nature. Nature affects everything, affects markets too. So as you can see, we had 40 years of plain sailing for the baby boomers. And what do I mean by that? Well, they could borrow to buy their homes. They could always remortgage at a lower rate. And what that does as well, a house acts like a bond. If you can borrow to buy a house at 3%, you're going to be able to pay a lot more than if you borrow at 10%. So the value of houses go up, value of bonds go up, the value of stocks go up. And as I said, the more money there is in the system, the more there is money out there to buy assets. So it's like a virtuous circle. But I would venture to say that 2008, 2009 was really a turning point because we saw central bankers abuse this bull market in bonds. And what do I mean by that? Well, we had the crisis of '08, the too big to fail banks, and the real estate market would have collapsed. And I think they should have let it collapse. We'd be in a much better situation now. But what did they do? Well, they applied Ben Bernanke's helicopter money policy. And what do I mean by that? Well, they started doing QE, the central banks. What is QE? Well, it's just the central banks buying bonds out of thin air with money they create out of thin air. And you can see here that the Bank of England's balance sheet, its assets, went through the roof. That's all that funny money they created to buy gilts. And you can see also the 10-year gilt yield did the same. The reason why I use the 5-year gilt yield is because it affects mortgages much more than the 10-year. So what do they do now with all this money? Yes, they buy the government bonds. It lowers yields. They also keep their policy or base rate at zero, as you can see here, which is totally outrageous, has never been done before. And they keep it there for like almost 15 years, as you can see. And that drives the housing market again. That allows government to keep borrowing, as you can see here. Even though I don't agree with her politics, she's pointing out that the national debt has gone from 770 billion in 2010 to almost 3 trillion now. And according to Carol Vorderman, the national debt has increased by 380 million pounds every day since 2010. And I'm not saying Labor is not to blame for this. I don't think it matters who's in power. Well, back when Tony Blair took over, the national debt was 350 billion. And I would say, though, that a lot of the increase we've seen since the Tories took over is to do with the bank bailouts in 2008 and 9, and Labor is responsible for that. So it doesn't really matter who's in power. I made a video back in before Brexit, the Brexit vote referendum, that they were going to use Brexit as a scapegoat for the troubles that we're going to have. I was forecasting this. Why? Because nothing had changed in terms of the debt. I knew that one day we'd have to pay for it. And you can see a lot of people are blaming everything on Brexit. I wouldn't be fooled by that. It's all to do with interest rates, bond yields, and the debt. So what's happened in the last 2 years that interest rates or yields have gone through the roof? Well, all that funny money that's helped baby boomers' nest eggs look really good, and it's just not just housing, but their pensions, because pensions, don't forget, pension fund managers and defined benefit pensions, they are forced by the regulators to invest in stocks and bonds. There's no investment in real things. It's all financial assets. So that's also put a rocket up. Pension values of baby boomers, their real estate holdings, it looks really good right now. And what I'm trying to say here is that a lot of pensioners and baby boomers especially, who are thinking of retiring, who are going to retire in the next few years up until 2032, that's when I think the last baby boomers will retire, and I'm one of them. I was born in '64, which is supposedly the last year for the baby boomers. Well, I think we're going to be in trouble. I think the value of our pensions and our real estate, our properties, are all going to go down massively. I don't know how much, but they will. And those of you out there who think you'll be able to cash in or cash out of your property and buy a smaller one, I think it's not going to be as easy. And also the value of your pensions are going to be affected massively because they hold a lot of bonds. And if yields are going to keep going up, the value of your pension is going to be going down. And we saw a crisis in that field already back in September of 2022 when gilt yields spiked massively in a very short amount of time. And the Bank of England had to come and intervene, or else the defined benefit pension, private pensions, would have collapsed in the UK. So we're still not out of the woods yet. And why do I think this is going to happen? Well, because everything that's too good and that lasts for a while always turns around. There's no such thing as always growing, right? In nature, you have night and day, you have the seasons, you have a windy day, you have a day that's not windy. It's all nature. So the same thing with the bond market, which is basically how cheaply you can borrow money. And I think, unfortunately, as you can see by the charts that I've showed you and I'm showing you again, I think that's over. And why do I think that? Well, having worked in the bond markets for over 20 years and having had to analyze the fundamentals of the economy, the fundamentals of government spending, also the technical analysis of charts. These charts to me show me that we are at a turning point. Yes, we've had a respite in the last 6 months or so where bond yields, gilt yields have dropped and mortgage rates have dropped and people have been able to refinance cheaper or get a mortgage. And so things look fine right now. But I can tell you that the financial advisors out there, mortgage advisors, they don't look at things longer term like this. They're always thinking short term, and they're always thinking of where the rates are now, what they're doing, and how much they can lend to you. And they're not looking at the bigger picture. They're not going to tell you this. Could I be wrong? Yes, but I think there's a big chance that this could happen. And I think 2021, 2022 is a turning point. And I think there's a lot of people out there, politicians, especially the central bankers, the guys in the city of London, the economists, they're hoping that this is just a blip. But I think it's a complete sea change. And as you can see, this bond market was built up over 40 years. It was gradual. Interest rates or yields kept going down gradually. Yes, there were ups and downs, but the trend was down. But have you noticed now, since it started going up, these yields, it's been very quick. And there's an old saying about bull markets, and in this case, bond, stocks, and housing bull market. The old saying is that, they're gradual and they go up an escalator, right? Just like if you turn this bond yield chart around, it's going up, right? Inversely related. But then when things change, you go down the elevator shaft. And I think, unfortunately, this change in interest rates, this change in asset prices is going to happen in a lot less time than 40 years. We could be talking, 3 to 5, 6 years, if you count from, let's say, the beginning of 2022. So What do you do in this situation? Well, hopefully this will make you aware of what's happening, so will help you make decisions in the next few years to do with your pensions, to do with your investments. But later on today, I'm going to be doing a live stream at 9 p.m. London with Clive Thompson. We're going to talk about how to test gold and silver coins and bars, but we're also going to talk about what to do in this situation, because Clive Thompson is a retired wealth manager in Switzerland, and I think he has some very good strategies, I think, for what's coming, and he agrees with me about the bond market. So there you go. Yeah, if you have questions, make sure you ask them in the comments section. And with that, I'm going to wish you all a very good rest of the weekend. Take care. Bye.